And so where does the argument say that we're too bullish? It comes from tech, where we do have some outrageous valuations. This morning, RBC downgraded two real high flyers, Trade Desk and Roku. We've had them on. Both stocks were able to bounce right back after opening lower. Roku stock ended up having a big day, rallying $1.68. Trade Desk fell almost 9 points and then finished in the black. This is what I'm talking about. So it's not like we're going crazy. Look at the internet stocks, Facebook and Alphabet, and we have more on Facebook there, are historically low valuations. Yes, the ancillary plays, Shopify, Twilio, and Etsy, they're pricey. But that's because investors are always going to be willing to pay up for what is rapid growth that's sustainable. Semis, I know, controversial. This group just had the beatdown of a lifetime, though. And while they bounced yesterday on the trade news, in particular the rollback of the Huawei blacklist, they came right back today. It's tough to value newly minted IPOs like Zoom Video or The Real, even Uber and Lyft. Beyond me, the whole class of 2019 is way too expensive in my eyes, and I think these stocks are indeed vulnerable. However, IPOs aren't a sector. They're just a subset of one group, with Beyond Meat thrown in for good measure, even though it's not really a tech stock at all. Look at the rest of tech, though. Intel, cheap as I've ever seen it. AMD's expensive, but not if the numbers come through, for heaven's sake. Micron sells for 6.4 times earnings. I mean, come on. That's one of the cheapest stocks I've ever seen. Software's got some pricey ones. I think some of the cloud kings are vulnerable. Splunk, ServiceNow, on fire every day. Salesforce, a lot of insiders selling. A Workday, down up 7 yesterday. All right. Adobe, they could plummet from these levels, and they still wouldn't be cheap. But that's been true for years, people. It's not even noteworthy. These cloud stocks have permanent overvaluations with periods of painful swooning that you had to buy. I think they have potential to go higher, maybe much higher if the economy shows signs of slowing and investors crowd into the consistent growers. But there's always a chance something goes wrong and they all blow up off of one. Remember a couple years ago when LinkedIn blew up the same day as Tableau did? Well, Tableau software, I want to think about it. Tableau software ended up being bought by Benioff at Salesforce, and the LinkedIn was bought by Microsoft. I mean, you can say the same thing for every software stock as a service. Any SaaS stock that gets hit is going to get bought. All right, here's one, fintech. To me, financial technology is the most overvalued part of the market. Visa, PayPal, American Express, MasterCard. But they're viewed as secular growers, so what? Every time they get hit, buyers come out of the woodwork. You want to go against FleetCor? Remember I recommended it? Some short seller said it was no good? Man, he's like, I think he's still on I-95 getting run over by 18-wheelers. Big cap techs, let's go over them, all right? This is important. Amazon, yes, vulnerable. Microsoft, after this run, vulnerable. Netflix, vulnerable. Apple, potentially vulnerable. These are the big ones that could potentially get pummeled, especially if the trade war heats up against Apple and gets caught in the crossfire. However, I think the deal the president just made is a major win for these guys. I wouldn't sell Apple. Still, when you look over the whole market, the idea that we're too bullish, it does not hold up under close scrutiny. While there are some overvalued stocks, overall people, I think, are pretty skeptical, regardless of what polls say. Bottom line, feel free to pull in your horns because you think there's too much enthusiasm. I'm not seeing it. As far as I'm concerned, there's too much exuberance in one particular subset of expensive tech stocks. But other than that, you're boxing with phantoms.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.